In late 2025, something pretty dramatic happened to the Indian rupee. It didn't just fall, it absolutely plummeted, kicking off a full-blown currency crisis. So in this explainer, we're going to break down exactly how it all went down, piece by piece.
Just look at this number, 90.75. On December 15th, that's where the rupee hit, an all-time low against the US dollar. To put that in perspective, this made it one of the worst-performing major currencies in the entire world. We're talking in the same league as the Turkish lira and the Argentine peso. Not good company to keep.
So you have to ask, right? How did the currency of one of the world's fastest-growing economies end up here, in such a shaky spot? What exactly was the tipping point?
Well, here's the thing. It wasn't just one single event. It was what you'd call a perfect storm. This crazy collision of three powerful forces all at once. You had a hostile trade situation, a really risky move with monetary policy, and a big geopolitical shock. So let's unpack each of those.
Okay, this chart here, it really lays out the whole collapse perfectly. You see that red line? That's the rupee's value just tanking. And those dashed lines, those are the key moments, the shocks that sent it spiraling down. So think of this as our roadmap. We're going to follow it to see how this crisis unfolded, starting with that very first jolt back in late August. All right, first up, a massive breakdown in trade. The United States, which is India's biggest trading partner, basically put up this gigantic tariff wall. We're talking staggering proportions here, creating a super hostile environment for anyone trying to export from India.
And this wasn't just some simple tariff, It was more like a 1-2 punch. First, you had a 25% reciprocal tariff that was supposed to fix the trade deficit. But then came the knockout blow, another 25% tariff, this one specifically to penalize India for buying Russian oil. You add those up and boom, a crippling 50% barrier.
The sheer scale of this is hard to wrap your head around. We're not talking about some small niche product here. That 50% tariff wall covered about 2/3 of everything India sells to the US. I mean, for an economy that relies so heavily on exports, that is just catastrophic.
So naturally, India tried to negotiate a way out of this mess. They came to the table with what they called a final offer, even making some big concessions on farm imports. But as you can see from this quote from the US trade rep, it just wasn't enough. The talks stalled, the tariffs stayed, and the market started to panic, basically pricing in a long, drawn-out trade war.
So, as if a massive trade war wasn't bad enough, the second hit came from a really unexpected direction: India's own central bank. The Reserve Bank of India, or RBI, made a move that just left analysts completely stunned.
Now, to really get what the RBI did, you kind of have to understand this classic economic idea called the impossible trinity. The gist is simple. A country can't have a stable currency, free-flowing money, and control its own interest rates all at the same time. You can have two, but you got to give one up. And the RBI, well, they were about to make their choice very, very clear.
Okay, so think about it. Your currency is falling. The textbook move, what everyone expects, is for you to raise interest rates, to make your currency more attractive. What did the RBI do? The exact opposite. They cut rates. They basically decided to sacrifice the rupee's stability to keep control over their own policy and try to boost the local economy. It was such a bold, risky move that commentators were calling it an act of sheer bravura.
And you can see the immediate result right here in this chart. By cutting its rates, the RBI made it less profitable for foreign investors to hold Indian assets compared to, say, US assets. That yield cushion, that extra profit, just got smaller. You see that orange bar shrinking? For big global investors, the message was loud and clear: time to sell. And that's exactly what they did, leading to a massive flood of money leaving the country.
Which brings us to the third and final ingredient in this perfect storm. So while you've got all this immediate chaos from trade and interest rates, something else was happening in the background. A big geopolitical move that sent a really chilling long-term signal to investors.
It was something called Pax Silica. The easiest way to think about it is like a new, super exclusive club. It was led by the US and was designed to control the most important supply chains for the future. We're talking semiconductors, critical minerals, basically the entire foundation of the AI economy.
And here's the kicker. Look at the members of this club. You've got the US, Japan, South Korea, all the heavy hitters in high tech. But who's missing? India. A major tech power and a supposed strategic partner was just left out. The buzz was that this wasn't because India couldn't do the job, but because there was a trust deficit, a question about which side India was really on, geopolitically.
So for the markets, this was a huge red flag. For years, the big story was that India would be the next great hub for high-tech manufacturing, especially for companies looking to move away from China. This snub, it just blew a massive hole in that story. It basically undermined the entire long-term reason for many foreign companies to invest in India.
So let's recap. You've got crippling tariffs, a surprise rate cut that sent money fleeing, and a major geopolitical snub. These aren't just abstract ideas on a chart. They have real and often devastating consequences. So let's take a look at how this perfect storm actually hit the economy on the ground. This risk matrix here is a great way to see who got hurt and who managed to weather the storm. Along the bottom, you have how exposed an industry is to those U.S. tariffs. And up the side, you have how vulnerable they are to the weak currency and higher import costs. It's that top right corner that's the real danger zone.
And here's a perfect example of that in action. Let's take the textile industry, smack dab in that danger zone. They were facing what was called an existential crisis. Orders just fell off a cliff, putting hundreds of thousands of jobs on the line. But then you look at gems and jewelry. Totally different story. They were incredibly resilient. How'd they do it? They were smart. They quickly pivoted away from the US and found new customers in places like the UAE and Hong Kong.
And if you thought things couldn't get more complicated, they did. There was this proposed law in the US, the HIRE Act, that was threatening to tax outsourcing. Now, it hadn't passed yet, but just the threat of it created a huge cloud of uncertainty over India's crown jewel, its massive IT services industry.
Now, this is a really important point. The rupee's collapse wasn't part of some big global trend where all emerging markets were struggling. It was very specific to India. As you can see on this chart, while the rupee was nosediving, other major currencies were actually doing pretty well. This led to a big strategy on Wall Street that traders called the Long Asia, Short India trade. Basically, they were betting on the rest of Asia while betting against India.
So where does all this lead? Really, there seem to be two possible roads from here. Scenario A, the best case. There's a diplomatic breakthrough. The US and India sort out their trade issues, and the rupee could see a big rally. But then there's scenario B, which many think is more likely. The gridlock continues, and the rupee just keeps grinding lower as the economic damage gets worse. The crazy thing is, its future now seems to depend more on politicians than on the markets themselves.
And all of this really boils down to one big critical question. This whole crisis, it's not just about exchange rates and tariffs. It's about a fundamental choice. Is this the price India has to pay for trying to forge its own path? For its strategic autonomy? In a world that seems to be demanding that you pick a side, do you have to choose between your foreign policy and your economic stability? That, right there, is the billion-dollar question that's going to shape India's future.